So, you put your money in the bank, right? You see the balance on your app. But have you ever wondered where that cash actually goes? I can tell you, it's not just sitting in some digital vault. It's on a journey, a really fascinating one that pretty much powers our entire economy. Today, we're going to follow that journey step by step and really pull back the curtain on the whole banking machine. Okay, let's get into it.
All right, let's make this real. Imagine you deposit 1,000 rupees. That simple action, it's not just a number changing in your account, it's the start of a massive chain reaction. We're going to follow that specific 1,000 rupee note to see exactly how it moves, who's pulling the strings, and most importantly, how it all comes back to affect you.
Okay, but before we can follow that money, we've got to understand the playing field. You can think of it like a giant game. There are rules, there are players, and there are definitely referees. And in India's banking system, everyone has a very specific role to play. Right at the very top, you've got the big boss, the Reserve Bank of India, or the RBI. It's the central bank, the ultimate authority. It basically sets all the rules for every other bank. Now, under the RBI, you have two main groups, scheduled and non-scheduled banks. Most banks you've ever heard of, the big national ones, the private ones, they're almost all scheduled banks. They are the major leagues.
So, what's the actual difference here? Well, it really just boils down to two things: rules and size. Scheduled banks are the heavyweights. They have to play by the very strict rules of the Banking Regulation Act, and they need to have a good chunk of working capital, over 5 lakh rupees. Non-scheduled banks, on the other hand, are smaller, more local players. And this difference is super important because it dictates how much power and responsibility each type of bank has.
All right, so we know who's who. Let's get back to our 1,000 rupees. It has just landed in the bank's account. What is the very first thing that happens to it? You might be surprised.
And here's where things get interesting right away. You might think the bank can just take that whole 1,000 and lend it out. Nope, not a chance. The RBI, our head referee, has a really important rule in place to make sure the whole system stays stable. A piece of your deposit is immediately taken out of play, and the bank can't even touch it.
This brings us to our very first key term, the Cash Reserve Ratio, or CRR. The easiest way to think about it is like a mandatory security deposit. Every single bank has to take a certain percentage of all its customer deposits and park it with the RBI. And get this, the bank earns 0 interest on it. It's purely a safety measure for the entire financial system. So let's break that down with our example. If the CRR is, say, 5%, then from your 1,000 rupees, 50 rupees is instantly sent over to the RBI. Just like that, the bank's ability to lend money is down to 950 rupees. This is the RBI's most direct tool for controlling how much money is flowing through the economy.
Okay, so the bank now has 950 rupees left to work with, and its main goal? To lend that money out and make a profit. But there's a huge risk involved, a big one that every bank has to be ready for, and that brings us to the next layer of protection. This is the nightmare scenario for any bank, what they call a bank run. Imagine a rumor spreads, people panic, and suddenly everyone rushes to the bank to withdraw their money all at once. If the bank has loaned out too much of its cash, it's in big trouble. It won't be able to pay everyone. To prevent that kind of chaos, the RBI has another rule.
And that rule is called the Statutory Liquidity Ratio, or SLR. You can think of this as the bank's own personal mandatory rainy day fund. It forces the bank to invest a slice of its deposits into really safe, liquid assets. We're talking about things like cash, gold, or government bonds, stuff that can be sold and turned into cash in a heartbeat if there's an emergency. It's basically a fire extinguisher for the banking system. So let's run the numbers again. If we assume the SLR is 20%, the bank has to take another 200 rupees and put it into these safe assets. So, first 50 rupees went to the RBI for CRR. Now 200 rupees is locked away for SLR. Out of your original 1,000 rupees, the bank is left with only 750. That's the actual amount it can use for its business and for giving out loans. You know, even with all these safety nets, banks can still run short on cash from time to time. Maybe they have a bunch of loans they want to approve or just need cash for their daily expenses. So what happens when the bank itself needs to borrow some money?
And believe me, this happens all the time. A bank might see a fantastic opportunity to give out a big business loan, but they just don't have the cash ready to go. So where do they turn? Well, they go to the lender of last resort, the head coach of the whole system, the RBI.
And this is where we meet the rock star of banking rates, the repo rate.
If you follow the financial news at all, you've heard this term a million times, and for a very good reason. The repo rate is simply the interest rate the RBI charges when it lends money to commercial banks for a short period. It is the single most important rate in the entire economy.
And the key difference, as you can see, is really just about time. The repo rate is for those short-term needs, to manage day-to-day cash flow. But if a bank needs money for a longer period, it borrows at something called the bank rate, which is usually a bit higher. It's kind of like the difference between a quick loan from a friend and a long-term mortgage.
Okay, now let's flip the script for a second. What about the opposite situation? What if a bank is actually swimming in cash and has more than it needs? Well, it can park that extra money with the RBI and earn a little interest on it. And the rate the RBI pays for that is called the reverse repo rate. It's a clever way for the RBI to soak up extra cash from the system to help keep inflation under control.
Okay, CRR, SLR, repo, reverse repo. I know, it's a lot of jargon, but here's the most important part. Why does any of this actually matter to you? This is where it all comes home, right into your wallet.
Just look at this ripple effect. Let's say the RBI raises the repo rate to fight inflation. That means it now costs more for your bank to borrow money. And what does your bank do? Well, it's a business. It passes that extra cost straight on to you. All of a sudden, your home loan, your car loan, everything gets more expensive. Your monthly payments go up. That is the direct line from an RBI meeting room to your personal budget.
And just one last piece to this puzzle. While the RBI kind of sets the direction for interest rates, each individual bank decides its own minimum lending rate. It's called a base rate. Think of it as the absolute floor below which they won't give out a loan. The RBI's moves influence it heavily, but the final call is made by the bank itself.
This really sums it all up perfectly. As one of our sources says, by controlling the repo rate, RBI can control the amount which is there in the economy. It's not just about what you pay on a loan. It's about managing the entire economic engine of the country. That's some serious power.
So the next time you see a headline about the RBI changing the repo rate, you'll know it's not just some boring financial news. You'll know it's the start of a ripple effect that will, sooner or later, reach your bank account. The banking machine is definitely complex, but now you know how the most important dials work. And that's a huge first step to making smarter decisions with your own money.